You've got $100,000 sitting there, and you're thinking, what should I do with this? I don't want it collecting dust in a savings account with next to no interest. Totally understandable. So here's the deal. You don't have to constantly check the stock market to make your money grow. There's a smarter way to do it. In this video, I'm going to walk you and Josh through 5 of the best Fidelity index funds where you can park that 100K. We'll break down what kind of returns you can expect in the next 10, 20, or even 30 years. I'll show you how your 100K in one of these index funds could turn into a portfolio that pays over $9,000 in monthly dividend income. And in the end, I will show you a fund that turns the same 100K into a portfolio worth over $14 million. Alright, before we get into the nitty-gritty of these Fidelity index funds, let's take a step back and lay a solid foundation for smart investing. Whether you're working with 100K or just starting out, understanding some key concepts is going to help you make much better choices. First of which is compounding. Let's break this down with an example to make things really clear. Imagine you invest $1,000 and your investment grows by 10% in the first year. By the end of the year, you now have $1,100. But here's the important part. The next year, you don't earn just 10% on the original $1,000. You now earn 10% on the full $1,100, which is $110. So instead of just earning $100 like you did the first year, now you earn $110. This is called compounding. Your money starts working for you. The more time your money has to grow, the faster it can multiply, because you're earning returns not just on your original investment, but also on the returns you've already earned. Think of it like a snowball rolling downhill. It starts small, but the longer it rolls, the bigger it gets. Now, investing isn't just about putting your money in one place and hoping for the best. It's about diversification, spreading your money across different sectors or types of investments. Imagine you're buying apples, oranges, and bananas instead of just all apples. If the apple market crashes, you still have oranges and bananas to fall back on. When you diversify, you're balancing the risk. And that's where index funds come into play. They're an easy way to diversify because they invest in lots of different companies all at once. Instead of picking individual stocks, an index fund lets you own a little piece of many companies, covering a wide range of sectors. This reduces your risk while still giving you a chance to grow your money through compounding. Let's kick things off with one of the most popular and widely recommended funds for broad market exposure, FXAIX, the Fidelity 500 Index Fund. This fund tracks the S&P 500 Index, which is made up of the 500 largest publicly traded companies in the United States. These companies represent the core of the U.S. economy, covering a wide range of sectors, including technology, healthcare, consumer goods, and financial services. FXAIX has proven itself over time with strong long-term growth. Over the past 10 years, the fund has delivered an annualized total return of 15.56%. That's pretty solid, especially when you consider its low cost and how much of the market it covers. This consistent growth is what makes it such a solid pick for anyone looking to build wealth over the long run. In the last year, FXAIX has returned 16.33%, showing that it can consistently keep up or outperform other investments, especially during periods of market volatility. The fund has benefited greatly from its heavy weighting in large-cap tech stocks like Apple, Microsoft, and Nvidia, which have all seen significant gains over the past year. The top 10 holdings alone account for nearly 40% of the fund's total value, making them key contributors to the fund's performance. These companies have been the backbone of the S&P 500's performance. One of the key benefits of investing in FXAIX is its consistent dividend income. The fund offers a dividend yield of 1.11% and has experienced 3.01% dividend growth annually over the last 10 years. Along with this, the fund has shown an annual share price appreciation of 12.55%, which helps boost long-term growth through compounding. This makes FXAIX a solid choice for those looking for both dividends and capital gains. Another standout feature of FXAIX is its ultra-low expense ratio of just 0.015%. That's super low compared to the average actively managed fund, which might charge 1% or more. When you keep fees low, more of your money stays invested and working for you, which really helps over the long term. Based on the data we've discussed above, let's take a look at how Josh's 100K would grow if he invested in FXAIX and let it ride for a while. In year 1, his portfolio would grow to $114,000, and he would receive about $1,100 in dividend income. By year 10, his portfolio would be worth about $348,000, with dividend income increasing to around $1,400. By year 20, his portfolio would reach $1,163,000, and Josh would be receiving about $1,700 in dividends. Over the years, the magic of compounding kicks in, and his investment grows faster. By year 30, Josh's portfolio would soar to $3,828,000, and his annual dividend income would be around $2,100. Now that we've seen how FXAIX can grow over time, let's explore another great option with a slightly broader market exposure, the Fidelity Zero Total Market Index Fund, FZROX. As the name suggests, FZROX gives you total market exposure, meaning it includes not just large-cap stocks, but also mid-cap and small-cap stocks from across the entire US stock market. This gives you a broader reach than the S&P 500, which focuses only on the largest companies. With FZROX, you own a piece of the whole US economy, including both established players and up-and-coming companies. FZROX has delivered solid returns over the years, with an annualized return of about 13.86% since its inception. This is a strong performance, especially when compared to other broad market index funds. It reflects the overall strength of the US economy, combining growth from both the big names and smaller high-potential companies. In the last year, FZROX has returned around 15.51%, which mirrors the performance of the broader market. This is driven by strong performances in sectors like tech, consumer services, and healthcare, all of which play a big role in the fund's success. Because it tracks the entire market, FZROX captures growth from both large-cap companies like Apple and Microsoft, as well as smaller, high-growth companies with more room to grow. One of the most attractive features of FZROX is its 0% expense ratio. That's right, no fees. Fidelity offers this fund with no management costs, which makes it an incredibly cost-effective way to tap into the growth of the broader market. This means more of your money stays invested and working for you, which is great for long-term growth. FZROX has a modest dividend yield of 1.02%, which is typical for broad market index funds. While the yield isn't the highest, the real strength of the fund is in its capital appreciation, with an impressive annual share price increase of 13.6%. Over the past 5 years, the fund has also experienced 7.19% annual dividend growth, which helps boost returns through compounding. This makes FZROX a solid pick for long-term growth, offering both dividends and capital gains. Let's now look at what would happen if Josh invests his $100,000 in FZROX and lets it grow over time. In year 1, Josh would see a dividend income of about $1,000, with his portfolio balance at around $115,000. By year 10, his portfolio balance would rise to about $383,000, and his dividend income would grow to $2,000. By year 20, Josh would be looking at $1,419,000 in his portfolio, with dividend income climbing to $4,000. Finally, by year 30, Josh would see his portfolio valued at around $5,173,000, with annual dividend income reaching $7,000. These are great returns, but there are even better options to come. Next, I'll show you an index fund that could turn $100K into a portfolio paying over $9,000 in monthly dividend income. And to top it off, I'll reveal a fund that could turn that same $100K into a portfolio worth over $14 million. But first, let's take a look at a fund that combines solid returns with a focus on sustainability, the Fidelity US Sustainability Index Fund, FITLX. If you're someone who wants to invest with a focus on environmental, social, and governance factors, then FITLX might be the perfect fund for you. This fund tracks U.S. companies that meet sustainability and ESG criteria, giving you the opportunity to invest in businesses that are not just growing, but are also contributing to positive societal change. Over the last 10 years, FITLX has shown strong returns with an annualized total return of about 15.9%. This solid performance proves that it's possible to align your investments with socially responsible principles while still achieving great growth. FITLX's returns have been in line with broader market indices, showing that sustainable investing doesn't mean sacrificing performance. In the past year, FITLX has returned approximately 18.42%, even with the market's ups and downs. The fund has benefited from strong performances in sectors like technology, green energy, and consumer services, all of which are key drivers within the fund's ESG framework. These sectors are growing fast, and sustainability is increasingly influencing market performance. Some of FITLX's top holdings include Nvidia, Microsoft, and Tesla, with these companies driving a significant portion of the fund's growth. The fund has a low expense ratio of just 0.11%, which is great for keeping more of your money working for you. Despite its focus on sustainability, FITLX remains a cost-effective choice for investors who want to align their investments with their values without compromising on performance. FITLX offers a 1.11% dividend yield, similar to other broad market funds. Over the last 5 years, the fund has seen a 15.42% annual growth in dividends, reflecting the strong earnings of the companies it invests in. While FITLX focuses more on capital appreciation, those steady dividends provide an additional stream of passive income, making it a great option for investors looking to reinvest and grow their portfolios over time. Additionally, the fund has experienced 13.16% annual share price appreciation, further boosting overall returns. Now, let's take a look at what would happen if Josh invests his $100,000 in this index fund. In year 1, Josh's portfolio is projected to be around $114,000, earning about $1,000 in dividend income. By year 10, his portfolio would grow to around $384,000, with dividend income rising to about $5,000. By year 20, Josh's portfolio would reach $1,512,000, and his dividend income would climb to about $22,000. By year 30, Josh will be receiving around $113,000 in annual dividends, which breaks down to about $9,400 per month, with his portfolio growing to $6,160,000. Now, let's look into a fund that's all about capturing the power of the tech sector, the Fidelity NASDAQ Composite Index ETF, ONEQ. This fund tracks the NASDAQ Composite Index, which is heavily weighted toward technology, biotechnology, and growth stocks. If you're looking to add a tech-focused or growth-oriented element to your portfolio, ONEQ is an excellent choice. The NASDAQ index is known for its high concentration of tech stocks, including the giants of the modern market. ONEQ has been a high-growth fund over the years. The 5-year annualized return is about 10.98%, reflecting strong growth driven by tech and growth sectors. Over the past 10 years, ONEQ has seen a long-term average annual return of approximately 19.06%, proving it to be a solid investment option for those looking to capture the growth of the NASDAQ. In the past year, ONEQ has returned about 13.75%, driven by strong gains in companies like Nvidia, Apple, Microsoft, and other major tech players. Since the NASDAQ composite is tech-heavy, ONEQ is particularly well-positioned to benefit from the growth of the technology sector, along with other high-growth areas like consumer services and communication services. The fund's top holdings include giants like Nvidia, Apple, and Microsoft, with other notable names like Amazon, Alphabet, Tesla, and Meta platforms rounding out the top 10. These companies have been key drivers of market growth, and their dominance in the tech sector makes ONEQ a compelling choice for anyone looking to capture the continued growth in this space. ONEQ comes with a net expense ratio of 0.21%, which is relatively low compared to many actively managed funds. That's a competitive fee for a fund that gives you broad exposure to high-growth tech stocks. It also offers a dividend yield of 0.55%, which isn't huge, but that's not what it's designed for. The real value of ONEQ comes from its capital appreciation potential, driven by the fast growth of tech stocks. Over the last 10 years, ONEQ has seen a 9.44% growth in dividends, and the annual share price has appreciated on average 16.32% every year. With reinvested dividends, the fund's total return keeps climbing, creating a nice compounding effect over time. Based on these metrics, here's what Josh's $100,000 looks like. In year 1, Josh's portfolio will have a balance of $117,000, and he'd receive about $500 in dividend income. By year 10, his portfolio would grow to $470,000, with dividend income increasing to $1,000. By year 20, his portfolio balance would rise to about $2,166,000, and Josh will be getting about $3,000 in dividends. By year 30, Josh's portfolio is projected to be valued at around $9,907,000, with annual dividend income reaching $6,000. And now, taking the top spot at number 1, we have the Fidelity MSCI Information Technology Index ETF, FTEC, a fund that puts the full spotlight on the booming tech sector. This fund is designed to give you focused exposure to the information technology sector by tracking the MSCI US Investable Market Information Technology 2550 Index. Unlike more diversified funds, FTEC targets some of the world's leading technology companies, making it a more specialized investment for those who want to zero in on tech. FTEC has consistently outperformed many broad market funds thanks to the ongoing strength of the tech sector. Over the past 3 years, it's seen an annualized return of 26.96%, reflecting the unstoppable expansion of tech companies. And over the past decade, FTEC has delivered an impressive 23.48% average total annual return, proving it's a strong contender for long-term growth. In the past year alone, FTEC returned about 15.66%, following the strong momentum of the tech sector. The fund has benefited from the solid performance of tech stocks, which have been a major driver for the U.S. economy. With heavy exposure to semiconductors, software, and hardware, sectors that have been on an upward trajectory, FTEC is in a prime position for continued strong performance. FTEC has a low expense ratio of 0.08%, which is very cost-efficient compared to many other actively managed funds. This low cost allows more of your money to stay invested and working for you, which is essential for long-term growth. FTEC offers a 0.44% dividend yield, focusing more on capital appreciation than immediate income. While the yield is on the lower side, the fund's true value lies in the growth potential of its holdings. Josh's $100,000 investment in FTEC is projected to reach $118,000 in the first year, with around $500 in dividend income. By year 10, his portfolio balance would rise to $537,000, with dividend income growing to $1,000. By year 20, Josh's portfolio would grow to approximately $2,835,000, and his dividend income would increase to $2,000. By year 30, Josh would be seeing $3,000 in annual dividend income, and his portfolio would reach an incredible $14,890,000. Want to know how to turn $25 a week into a $1.6 million portfolio that pays over $6,000 in dividends every month? Click the video on screen to find out how.